moving on then to global equities, it is important to look at where you're investing. So when people talk about the global market, in most cases, people refer to this as the 23 or 22 developed markets, which is US, Canada, most of Europe, Australia, New Zealand, and Japan. Depending on which global index you look at, South Korea may or may not be in there. So this is the MSCI, or Morgan Stanley Capital Investors. This is probably the OG of global indexes, and it weights each market in accordance with its market cap, and then companies within those markets by market cap. And it covers 23 developed markets. There's also then what are called emerging markets, which is another dozen or so companies that don't quite have the same level of sophistication. They may not have quite the same level of regulation. The quality of government may be slightly different. And that includes some pretty big players. It's got China, India, Brazil, South Africa. Now, you'll note that Russia is not included here. It isn't part of the index anymore, but it was. So that's the MSCI. The other competitor is the FTSE Global Markets, the FT being Financial Times Stock Exchange. So that's the London Stock Exchange and the Financial Times collect this one. And the key difference between this one and the MSCI is the treatment of South Korea. So South Korea is a developed market in the FTSE, but an emerging market in the MSCI. And this matters when you start mixing. So what you don't want to do is choose a FTSE developed market and pair it with an MSCI developed market. So be aware that not all indexes are created equal. So when we look at global, again sticking to large companies, the main products here, the US obviously big starting point. It's now about 70% of global markets. And the two main ways of getting access to the US specifically is through the iShares, the BlackRock S&P 500. So the S&P 500 is the 500 largest companies listed in the US. That's on the New York Stock Exchange and on the NASDAQ. VTS, in true American exceptionalism, calls itself the total market index. What that means is it includes big companies, medium companies, and small companies, all listed in the US. So that's a broader index. It's less liquid, harder to hedge, but to all intents and purposes, they're very similar. We prefer the clean exposure to the S&P 500, and it's also a simpler and more straightforward structure. It's a classic ETF. It invests in the physical underlying shares. VTS, on the other hand, is what's called a CHESS depository receipt, which means the stock exchange in Australia goes and buys a unit in a US ETF called VTI, which is broadly the same as the underlying Vanguard managed fund called VTS. If you've read any of J.L. Collins or spent any time on Reddit, you'll be familiar with VTSAX, which is the darling of, that's actually a managed fund, but broadly the same thing in the US. It's also one of the funds that owns Vanguard. So by buying VTS, not only are you buying this structured product in Australia, you're also investing in a entity that owns part of Vanguard that manage it. So that's not a risk that we're comfortable taking for 1 basis point or 0.01%. So our preferred exposure to the US market is IVV. There's not a huge amount of difference in long-term performance, and much of the difference has been swamped by the impact of the Big Seven over the last few years. When you move beyond the US, we like to look at VEU. Now, oddly, that's also one of the funds that owns Vanguard, but nonetheless, it's the world excluding the US, and it includes some emerging markets. The other alternative for the global space is VGS, which is the MSCI World ex-Australia, which is a developed market index. And often people might pair that with VGE to get the emerging markets. But bear in mind that VGE tracks the FTSE, whereas VGS tracks the MSCI. So be aware of the different economy inclusions there. So we generally use IVV VEU to get our global exposure, and that's because it allows us to tweak the difference, the weighting between the US and the rest of the world. Whilst indexing is an important way of capturing the value within a particular market, it's not necessarily a particularly good way of allocating between markets. So, for example, the global bond market is bigger than the global equities market. So is that a reason to put more of your money in bonds than you put in shares? Nobody would suggest that. So because the US is 70% of the world, doesn't mean you should put 70% of your money. So we like the ability to vary that ratio a little bit. But there are, of course, other ways of doing that. But that's our pick there. And again, you can see these are all fairly low cost. Emerging markets, that's just a more expensive class to manage. So you would expect to see an emerging markets fund to cost you more than a developed markets funds. You'll also see slightly higher spreads, and you'll probably see slightly higher transaction costs. So that's the thing to look out for there. So we've just covered off all of that. So that's why we use IVV VEU. So that's the main big company markets. You can, of course, and probably should look at how do I invest in smaller companies? How do I overestimate or overweight a particular market? How do I capture the small cap premium? We do that within Australia using managed funds, though it's very hard to get broad-based indexes that are useful in those spaces. But that's a story for another day.